Welcome, deep divers. Today, we're diving into a company that, well, it really sits right at the heart of this whole AI revolution. A company that isn't just, reacting to the future. It feels like they're actually building the infrastructure for it. NVIDIA. I mean, think about it. A company fundamentally reshapes the tech landscape, moving from specialized
For
graphics,
gamers, yeah.
exactly, for gamers, to becoming the central architect of AI. It's just an incredible story. Foresight, execution, the whole package. Okay, so let's unpack this. For this deep dive, we're going to pull apart a really extensive investment analysis on NVIDIA. We want to get beyond the headlines, understand its unprecedented dominance, but also the intense challenges it's facing and what that current market valuation really means. Our mission here is basically to give you a shortcut, help you get well informed, provide the crucial insights, the context, help you grasp the why behind the what of this tech giant.
And we really mean deep. The goal is to unravel NVIDIA's unique position, right? Dissect its extraordinary financial performance, explore the evolving and definitely increasingly competitive landscape, and really pinpoint the significant risks threatening its continued growth. We'll also dive into this idea of an unassailable moat built by its software ecosystem, NVIDIA primarily, and what their capital allocation strategy tells us. Ultimately, we have to ask, what does NVIDIA's current market value truly expect from its future? It's a fascinating puzzle. High stakes, for sure.
Absolutely. So let's trace this story. You've got this company famous for making games look amazing. And they see this massive industry shift coming. And they don't just adapt, like you said, they fundamentally reshape their whole identity. So we'll kick things off by exploring how NVIDIA managed this journey from gaming specialist to, the undisputed AI powerhouse. It wasn't just like an evolution. It was a fundamental refounding, wasn't it? A huge strategic bet that just paid off incredibly well.
That's exactly right. From its roots making high-performance GPUs for gaming, NVIDIA made this pivotal, really audacious strategic bet. They saw early on that the massive parallel processing power of their GPUs, initially designed for complex graphics.
Right, rendering pixels.
Exactly. Was actually perfectly suited for the computational demands of machine learning. And eventually, these huge, large-scale AI models. The key insight, and this is crucial, is that NVIDIA's offering isn't just hardware. It's not just a chip. We're talking about an entire accelerated computing platform. It's a tightly integrated ecosystem. Hardware, software, networking components all working together. And this complete platform has kind of remarkably become the standard, the go-to solution for training and deploying these massive AI models, driving innovation across pretty much every global industry you can think of.
When you say powerful, you're not exaggerating. Their market dominance is it's really striking. You look at the numbers, right? NVIDIA holds an estimated 70% share of the entire AI infrastructure market. Just think about that.
70%.
Almost 3/4 of the foundational tech powering AI runs on their stuff. And if you narrow it down, look specifically at GPUs used for AI model training, their share jumps to over 80%.
80% plus.
These figures aren't just stats. They really signify NVIDIA's almost indispensable role. They're like a foundational layer for almost every major AI development happening today. It's a level of control you just rarely see.
Very rare. And what truly solidifies this hardware supremacy, what underpins it, is their software platform, CUD, Compute Unified Device Architecture. CUD isn't just some add-on. It's the critical software foundation. It's what enables NVIDIA's GPUs to be so powerful for general-purpose computing, not just graphics. NVIDIA's been cultivating CUO for, over a decade now, investing heavily.
Full time.
Yeah, and this long-term commitment has created deep entrenchment and, crucially, really high switching costs for developers and enterprises. Think about it. Millions of researchers, developers, they've built their careers, their most complex AI models, on CUD. Moving away from that ecosystem, it's not just difficult. The analysis actually calls it economically unviable for many. That creates this formidable, almost invisible barrier to entry for competitors.
Economically unviable. That's a really strong phrase.
Yeah.
But are we sure this moat is genuinely unassailable? Couldn't a really well-funded competitor, maybe by throwing money at developers or offering truly superior hardware cheaper, can they eventually chip away at CUD, even if it takes years? Or is that switching cost truly that high for the majority of these big AI projects? What makes it so hard to just port your code?
That's the million-dollar question, isn't it? And it really gets to the core of their advantage. It's not just about porting code, see? It's the entire ecosystem. When we say economically unviable, we're talking about hundreds of highly optimized software libraries like cuDNN, cuDelays.
Right, the building blocks.
Exactly. Development tools, debugging suites. Years and years of accumulated knowledge that developers have built on CUDA. These aren't simple scripts, you know?
Yeah.
They're complex, high-performance routines designed to squeeze every last drop of power out of the GPU. To replicate that on a different platform, let's say AMD's ROCm, well, it means rewriting huge amounts of specialized code, retraining entire teams, and potentially sacrificing years of performance optimization work. The opportunity cost, the risk of bugs, the sheer engineering effort.
Yeah.
It often just outweighs any potential hardware cost savings.
Okay.
It's less about one developer switching and more about whole industries being embedded in this ecosystem. That's the real lock-in.
That makes a lot more sense. It's the whole stack.
Okay.
And speaking of value, this market position is obviously translated into, well, truly extraordinary financial performance. We're talking unprecedented growth, unprecedented profitability. Fiscal year 2025 revenues just exploded, up 114% to a massive $130.5 billion.
It's staggering.
And it's not just the top line. Profitability expanded dramatically, too. Their GAAP gross margin hit an incredible 75.0% in FY25. And for those maybe less familiar, GAAP generally accepted accounting principles just ensures this key metric is reported consistently, transparently.
Right, it's standard.
And 75%.
Yeah.
That level of profitability is exceptional, almost unheard of in the semiconductor industry, which is usually super capital intensive. It's a clear sign of the pricing power NVIDIA has.
Absolutely. They're not just selling chips. They're selling this integrated, high-value solution that customers clearly see as, well, indispensable.
Precisely. And this brings us right to the central investment debate around NVIDIA, which is really what this deep dive is all about exploring. On one side, you've got the argument that NVIDIA's dominance is supported by this, almost unassailable CDA mode and their full stack approach, that it's an enduring monopoly-like advantage. And that justifies the premium valuation. It's the engine powering the future.
That's the bull case, yeah.
But then on the other side, there's this critical question. Is the company maybe at an inflection point? You've got this convergence of risks, intensifying competition from peers, and its biggest customers building their own stuff.
The hyperscalers.
Right. Plus, persistent geopolitical tensions and just the sheer challenge of maintaining hypergrowth at this massive scale.
Yeah.
Could all that lead to a normalization, a leveling off of growth and margins?
That's the core tension, the tightrope walk, as you put it. Dominance versus risk.
Exactly. And to really get our heads around it, we need to zoom out a bit, put NVIDIA's story into the broader context. The global semiconductor industry, the AI hardware explosion, the semiconductor industry itself is fascinating, isn't it? It's got this robust long-term growth trend, secular growth.
Driven by everything needing chips now.
Right. But it's also notoriously cyclical, volatile. We're talking a market hitting $630.5 billion in global sales in 2024, projected to grow over 11% to $701 billion in 2025. And some analysts are eyeing, $2 trillion by 2032? That implies a compound annual growth rate of 15.4% from 2025. Huge numbers.
Huge.
But how can an industry grow that fast and still be so cyclical? It seems like a contradiction.
It is a paradox, isn't it? The growth drivers are powerful, no doubt. AI, 5G, 6G, autonomous vehicles, they all create this just insatiable demand for more advanced chips. Yeah. But the growth isn't linear because the capital investment needed is enormous. This industry's seen, 9 distinct contractions in the last 34 years?
Wow, 9 times.
Yeah. These cycles happen because there's often a mismatch between these huge capital investments in new factories, fabs, which take years to build,
right,
and the fluctuating demand in the end markets. So you get periods of oversupply, price pressure, boom and bust, essentially. What's also clear are the incredibly high barriers to entry. The massive capital needed, especially for R&D. The U.S. semiconductor industry alone invested, $62.7 billion in R&D in 2024? That's nearly 18% of its sales.
Almost a fifth of revenue back into R&D.
Exactly. That kind of spending heavily favors the established players, the incumbents like NVIDIA. You can't just start a cutting-edge chip company easily. It takes billions, decades of expertise, a global supply chain.
And what's really fascinating here is this crucial trend the analysis points out. Revenue growth is decoupling from just raw silicon wafer volume. The value isn't just in cranking out more wafers anymore. It's in the architectural complexity. Think intricate assemblies of tiny chiplets, high bandwidth memory, sophisticated packaging techniques like TSMC's CoWoS. Now, CoWoS, for anyone maybe not familiar, chip on wafer on substrate, basically stacking components vertically. Shortens the distance data travels, boosts performance massively. It's incredibly complex stuff.
State of the art.
So this trend It heavily favors the fabulous design leaders like NVIDIA, right? They control the high-value architecture, but it also makes them even more dependent on a few advanced manufacturers, especially TSMC. What does that mean for the industry? Does it just concentrate power even more?
It absolutely does. It means the brains, the design, the software ecosystem become even more critical. That old saying, software eats hardware. It's increasingly true here. NVIDIA designs the chips, sure, but they rely on foundries like TSMC to actually make them using these incredibly complex techniques like CoWoS. Think about this. Generative AI accelerators might only be like 0.2% of total wafers produced, tiny fraction, but they represent a massive 20% of industry revenues.
Wow, that's disproportionate.
Totally. Tells you exactly where the value is being captured in the intelligence, the integration, not just the raw silicon volume, and right at the epicenter of this shift. That's the AI hardware gold rush. This is NVIDIA's main playground, and its growth is just explosive.
Mind-boggling is the word. When you look at those gross numbers for AI hardware, yeah, it's easy to get swept up. Estimates vary, but they all point skywards, from maybe $25 to $60 billion in 2024. Projections for 2032, 2034 are hitting $200, even $300 billion.
Yeah, TGRs of 18% to 23%. Just huge sustained growth expected.
And this hardware market, it's just one piece of the whole AI ecosystem, right?
Yeah.
Which is expected to be nearly $1.8 trillion by 2030. Software services, everything. But it's not just bigger numbers. It's driven by a fundamental architectural shift in computing. I mean, data centers are literally being re-architected. It's like the whole global computing infrastructure is going through, I don't know, a growth spurt.
That's a great analogy, and it's exactly right. This isn't just an upgrade cycle. It's a refounding of how we process information. Driven by generative AI, large language models, these new AI workloads demand massively parallel processing. Traditional data centers built around CPUs, central processing units, they just can't handle it efficiently.
They're built for sequential tasks, mostly.
Exactly. Great for one thing after another. But when you need to process trillions of data points all at once, they bottleneck badly. GPUs, though, with their thousands of smaller cores, they're uniquely suited for this parallel work. They're the new primary engine. So data centers are quite literally being rebuilt into AI factories around these huge GPU clusters. And NVIDIA's strategic foresight. Investing over a decade ago in general-purpose GPU computing with CUA, it positioned them perfectly, gave them this undeniable first-mover advantage. They saw this coming way before most others.
Which brings us to a really significant and often pretty contentious part of this whole picture, the geopolitical battleground. Semiconductors have become this key arena for geopolitical competition. It's tied directly to AI leadership, economic strength, national security. Yeah. We're seeing this global chip race. Governments pouring hundreds of billions into subsidies, incentives, trying to boost their own domestic chip ecosystems, like the U.S. CIPS and Science Act, sparking this huge reindustrialization effort. Over $500 billion in announced private investments aiming to triple U.S. chip-making capacity by 2032, create 500,000 jobs.
Huge ambitions.
But building these advanced factories, these fabs, it's incredibly complex, right? It's not just pouring concrete.
Incredibly complex, yes. But there's an even bigger potential catch beyond just building them. This global push for new fabs. It's crashing head-on into a worsening shortage of skilled talent. Chip design, manufacturing, maintenance. There just aren't enough specialized engineers to go around.
Right, you need people to run them.
Exactly. This competition for a limited pool of experts could cause significant project delays, drive up costs, potentially constraining the very growth everyone's hoping for. It's a major bottleneck.
And the most acute geopolitical factor right now, it has to be the escalating U.S.-China tech rivalry. The U.S. government has put in place really stringent export controls on advanced chips going to China, especially those seen as critical for military use or advanced AI.
Dual-use concerns.
These restrictions directly hit NVIDIA's business. They're forced to design specialized, often less powerful, compliant chips just for the Chinese market. And navigate this super complex, constantly shifting regulatory landscape. We've seen the financial impact already, haven't we? Real-world consequences. Q1 fiscal 26, NVIDIA disclosed that $4.5 billion charge for H20 chip inventory and purchase obligation.
Yeah, the chips they couldn't sell.
Right. And they couldn't ship another $2.5 billion of H20 revenue because of new licensing rules. And looking ahead, management anticipates an $8 billion loss from H20 sales to China for Q2 FY26. That is a huge hit.
It truly is, and the situation is just incredibly fluid. There were those reports, remember, about a potential deal, letting NVIDIA and AMD sell certain advanced chips to China in exchange for a 15% revenue share going to the U.S. government.
Which sounds unprecedented.
Highly unusual, yeah. But then that got complicated by reports that Chinese officials, reportedly angered by comments from the U.S. Commerce Secretary, calling China's chip ambitions deeply insulting.
Ouch.
Yeah. Have apparently pressured Chinese tech firms to reduce their purchases of these U.S. chips, which naturally just accelerates China's push for self-sufficiency and creates huge uncertainty for a market that used to be, what, 13% of NVIDIA's revenue?
Right. Significant chunk.
It's a clear example of how geopolitics can hammer even the most dominant tech companies.
It's like walking through an economic minefield.
Yeah.
Okay, so let's shift focus. How does NVIDIA plan to sustain this dominance? Through innovation, strategic pivots, especially given all these challenges. Their market share in AI accelerators is just commanding. We said 70% overall AI infrastructure, an incredible 92% of discrete desktop laptop GPUs in Q1 FY25.
Still dominant there, too.
And over 80% in the really crucial data center AI accelerator segment. This kind of leadership isn't luck, right? It's fueled by just relentless innovation.
Absolutely. Relentless is the right word. NVIDIA maintains this rapid cadence, constantly introducing new, more powerful GPU architectures. Take their recent Blackwell platform. They claim it delivers up to a 25x improvement in efficiency for some AI inference workloads compared to the previous generation.
25 times? That's not incremental.
No, it's a leap. And this continuous cycle of performance gains just keeps raising the bar. It forces rivals into this perpetual game of catch-up. NVIDIA basically acts as the technological standard bearer for AI computing. They set the pace for the whole industry.
So what does this all mean for NVIDIA's actual business model? Their biggest strategic transformation, arguably, has been this profound pivot from being mainly a PC gaming company to one just overwhelmingly dominated by enterprise and cloud data center sales. This shift has completely remade their financial profile, their growth drivers, their priorities. It's like they became a different company almost overnight.
You can see it so clearly in the segment revenues. Fiscal year 2023, data center was, what, 55.6% total revenue?
Just over half.
Right. 2 years later, fiscal 2025, that surged to an incredible 88.3% of total revenue. That's $115 billion out of $130 billion total. Meanwhile, gaming contracted dramatically, from over a third of revenue down to just 8.7%.
Wow. Huge shift.
This realignment has essentially turned NVIDIA into a core enterprise and cloud infrastructure provider. Their business model is now much more tied to enterprise IT spending, hyperscaler CapEx, less tied to volatile consumer electronics cycles. It's a much more stable and profitable foundation.
But despite this dominance, they do face competition, though the analysis calls it asymmetric. What does that mean exactly? Are rivals just sort of nibbling at the edges, like you said, targeting niches instead of a full-on assault? And how effective can that new strategy really be against a giant like NVIDIA?
That's a great question, and it's a really critical distinction. Asymmetric means rivals aren't trying to beat NVIDIA head-on across its entire integrated platform, the hardware, the software, the networking, the whole ecosystem. That would be incredibly hard. Instead, they're usually targeting specific niches, often focusing on performance per dollar for certain workloads, or maybe trying to gain traction with open-source software alternatives. Let's look at AMD, for example. They're NVIDIA's most direct GPU competitor.
Right.
Now, they're still much smaller. NVIDIA's data center revenue was over 7 times AMD's in 2024. But AMD is executing a focused strategy, their Instinct line of accelerators. It aims to compete on performance per dollar, especially for AI inference workloads, which are expected to become a bigger slice of the market over time.
Okay, so AMD is targeting inference, going for the value play, but they face a couple of big hurdles, right?
Exactly. 2 main ones. First, their RCM software platform. That's their open source alternative to CAD. It's just significantly less mature. It lacks CAD's huge ecosystem, the decades of developer familiarity.
Back to the switching costs.
Precisely. That's hurdle number 1. Hurdle number 2. AMD might struggle to get enough advanced packaging capacity from TSMC for these high-end AI chips. NVIDIA reportedly reserves over 70% of the available TSMC lines for advanced packaging like CoWoS. That's a massive supply constraint for AMD. It puts them at a disadvantage, even if their chip designs are great.
Wow, 70%. That's like being squeezed out before you even start. Okay, what about Intel? They're pursuing a different strategy, aren't they, with their Gaudi line? Sounds like they're not going for raw performance ground, but more a cost-effective solution for mainstream enterprise AI. What kind of performance are they claiming? And what's the biggest hurdle? Still software.
You're right, Intel's approach is different, more about value, accessibility for broader enterprise use. Benchmarks suggest their Gaudi 3 can be competitive with, sometimes even outperform, NVIDIA's previous Gen H100 chip for specific workloads, especially ones with large output token sequences. They're claiming a significant workload per dollar advantage, so not necessarily the fastest overall, but maybe better bang for your buck for certain tasks. But yeah, like AMD, Intel's biggest challenge isn't really the hardware specs, it's the software. Convincing developers to move away from that deeply entrenched CADA ecosystem, even with a good price-performance story, that developer inertia is just formidable.
And then there's the elephant in the room, or maybe the frenemy in the room, the hyperscaler dilemma. This is arguably the biggest long-term threat. Coming from NVIDIA's largest customers, Google, Amazon, Microsoft.
Meta, too.
Right, Meta. These giants are pouring billions into designing their own custom silicon. ASICs application-specific integrated circuits. For those less familiar, ASICs are chips designed for one very specific task, unlike a general-purpose GPU, so they can be super efficient for that task.
Highly optimized.
Exactly. So these hyperscalers are building chips tailored to their own software, their own data centers, like Google's TPU's tensor processing units, purpose-built for AI in Google Cloud. Great performance per watt for specific TensorFlow models.
Right.
Maybe less versatile, though.
Less flexible.
But how big a threat is this really, given NVIDIA's position? Can they really replace NVIDIA wholesale?
That's the core of the frenemy dynamic, isn't it? They're NVIDIA's biggest buyers, but also potentially their biggest long-term competitors. Amazon Web Services, AWS, they're aggressively developing their own chips too, Trainium for training, Inferentia for inference, trying to cut costs, reduce their reliance on NVIDIA. AWS claims Trainium can match H100 performance at 25% lower cost, and their next-gen Trainium 3 aims to double performance, halve energy use. Big claims.
Very big.
Microsoft's in the game too with their Maya accelerator, though they've reportedly had some production delays, which just highlights how incredibly complex building these custom chips really is. So the threat is definitely real, but it's probably not a simple one-for-one replacement scenario.
Right. That complexity point is key. This frenemy dynamic is a central risk.
Yeah.
But what's kind of fascinating is that the fact these hyperscalers are doing this, investing billions, it's also a massive validation of the huge market NVIDIA basically created, right?
Absolutely.
And the technical challenges, the delays these incredibly capable companies are facing, it just underscores how exceptional NVIDIA's execution has been.
Very true. It's not easy.
So what's the most likely outcome here? Will NVIDIA get pushed out, or is it more nuanced?
It's definitely more nuanced. The most probable outcome isn't a complete replacement of NVIDIA GPUs. It's more likely a hybrid cloud environment. Hyperscalers will probably use their own custom ASICs for their stable, predictable internal workloads, where they can really optimize the chip for their specific software.
Makes sense. Internal stuff they control.
Right. But they'll likely still offer NVIDIA's more flexible, general-purpose GPUs to their external cloud customers. Those customers need versatility, they need access to the industry-standard CUD platform, they need to run all sorts of different AI models without huge re-engineering efforts.
Okay, so NVIDIA remains crucial, but maybe less exclusive in those hyperscaler data centers over time.
That's a plausible scenario, yeah. They'll likely coexist.
Okay, let's shift gears again and deconstruct the financial engine powering this empire. NVIDIA's financial performance over the last few years. It's been genuinely extraordinary. The generative AI boom was this massive inflection point for their revenue growth. Annual revenue was kind of flat around $27 billion in fiscal 22-23.
Plateaued briefly.
Then fiscal 24. Revenue more than doubled to $50.9 billion.
Yeah.
And then it doubled again in fiscal 25 to $130.5 billion.
Doubled, then doubled again. Insane.
And the momentum's still there.
Yeah.
Q1 fiscal 26 revenue hit $44.1 billion. That's a 69% increase year over year.
Yeah.
These numbers are just astounding. How does a company this big manage to double its revenue twice in 2 years? What's driving that insane acceleration?
It really is a generational growth trajectory, that acceleration. It's driven by the perfect storm of unparalleled demand for AI infrastructure, combined with NVIDIA's unique position as the primary supplier for it. They were ready when the wave hit. And this revenue explosion has come with even faster growth and profitability, which really shows the powerful operating leverage in their fabless model. Annual net income surged from $4.37 billion in fiscal 23 to a mind-blowing $72.88 billion in fiscal 25.
$72 billion net income.
Yeah. Operating income went from $4.2 billion to $81.5 billion in the same period. These are numbers you just you don't normally see, not even from the most successful companies.
And if we connect this back to the bigger picture, NVIDIA's profitability metrics are truly best in class, underscores that pricing power from their tech moat.
Yeah.
Their annual GAAP gross margin expanded from, 56.9% in FY23 to 75.0% in FY25.
75%.
Recent quarterly non-GAAP margins have been consistently in the mid-70s, and management's guiding for continued strength. But why is that gross margin so exceptionally high for a company selling hardware? What makes it feel more like a software company's margin?
That's a great observation, and it really points back to that moat, especially CUDA. It's because customers aren't just paying for the silicon, the physical chip. They're paying for the whole integrated platform, especially the CUDA software ecosystem. The value isn't just the manufacturing cost, it's the decade plus of software development. The huge developer community, the optimized libraries, the performance breakthroughs.
Right, the whole package delivers the value.
Exactly, and that value is reflected in their pricing power and the scalability of their model. You see it clearly in the operating margins, too. As revenue soared, operating expenses grew much slower. So operating margin exploded from 15.7% in FY23 to 62.4% in FY25.
Wow.
That shows that each extra dollar of revenue brings very high incremental profit. That's powerful operating leverage, makes them incredibly efficient as they scale.
And this amazing profitability has let NVIDIA build what the analysis calls a fortress balance sheet, gives them immense financial flexibility. End of fiscal 25, total assets $111.6 billion versus total liabilities of just $32.3 billion.
Very healthy.
Modest long-term debt, about $8.5 billion. Strong net cash position. Super low debt-to-equity ratio of 0.11. What kind of strategic edge does that kind of financial strength give them? Does it let them make bigger bets, weather storms better?
Both, absolutely, and more. That kind of strength is fueled by massive cash flow generation. Fiscal 2025, cash flow from operations was $64.1 billion. After capital expenditures, they generated almost $61 billion in free cash flow.
$61 billion free cash flow.
Yeah.
In 1 year.
Yeah. This massive cash generation gives them a huge capacity for continued heavy R&D investment, which is critical in this fast-moving field. It enables strategic acquisitions like Mellanox to fill tech gaps or expand their ecosystem. And it allows for significant capital returns to shareholders, all without straining the balance sheet at all. It's a huge competitive advantage. Gives them defensive resilience and offensive firepower.
Okay, let's move on to explore what we've called NVIDIA's unassailable moat, that CAD ecosystem and their full-stack strategy. We touched on Sheeta earlier, but let's dive deeper. This really is the cornerstone of their competitive advantage, isn't it? It's this proprietary parallel computing platform, the API. Lets developers use NVIDIA GPUs for general-purpose computing. But coming back to my earlier skepticism, what truly makes it unassailable against well-funded players like AMD with ROCm or the hyperscalers with their custom ASICs? Is it really impossible for others to break through that lock-in?
Well, impossible is a strong word in tech, right? But unassailable in the sense that the barriers are incredibly high and multi-layered. Over more than a decade, NVIDIA has cultivated CUDA into this expansive environment. Hundreds of highly optimized software libraries, cuDNN for deep learning, cuBLES for linear algebra.
All the tools developers need.
Exactly. Robust development tools, debugging tools, support for multiple languages like C++, Fortran, Python. This rich ecosystem created a powerful network effect. Millions of AI researchers, data scientists, developers, they've been trained on CUDA. They've built their applications using CUDA. They basically speak CUDA natively now.
It's the language of AI development almost.
Pretty much. So porting these complex, highly optimized AI models and software stacks to a competing architecture, it's not trivial. It's often described as not just time-consuming, but, back to that phrase, economically unviable. Because of the huge engineering effort, the potential performance drop. Imagine a big company with hundreds of AI models running, all fine-tuned on CUDA, teams of engineers specialized in that stack. The cost of retraining, rewriting, reoptimizing everything for a new platform could easily be tens, hundreds of millions of dollars, plus significant delays, performance risks.
Okay, yeah. The inertia is massive.
Exactly. This creates a durable software lock-in, makes it exceedingly difficult for competitors to gain meaningful market share quickly. Even if they offer comparable hardware or a lower price, it's the full stack, not just a chip swap.
And what's fascinating here is how NVIDIA built on that CUDA foundation with their AI factory strategy. This deliberate move towards vertical integration, aiming to give customers a complete end-to-end AI factory solution, moving up the value chain. Not just selling GPUs, but offering fully integrated systems. Compute, networking, the critical software layer. How does this vertical integration deepen their moat even more? What challenges does it create for competitors?
It deepens the moat exponentially, really. Because now a competitor doesn't just need a better GPU, they also have to replicate over a decade of software development, networking integration, developer ecosystem building.
The whole system.
Right. Makes the competitive challenge way, way harder. A key enabler for this AI factory strategy was that acquisition of Mellanox Technologies back in 2020 for $6.9 billion.
Right, the networking piece.
Exactly. Mellanox was a leader in high-performance networking. InfiniBand, high-speed Ethernet, for those maybe less familiar, InfiniBand is this high-speed networking protocol used a lot in high-performance computing, designed to move massive amounts of data between servers and GPUs with extremely low latency, absolutely critical when you're connecting thousands of GPUs in these huge AI training clusters.
Got to keep the GPUs fed with data.
Precisely. Bringing that expertise in-house allowed NVIDIA to optimize the entire data flow across the data center, storage, networking, compute, tackling critical performance bottlenecks that pop up in these massive data center scale AI workloads. This integration is central to CEO Jensen Huang's vision, right? Architecting future data centers as single giant compute engines, where the network fabric is part of the computing fabric. Total integration, total control, total optimization.
And innovation is clearly a weapon for them. NVIDIA sustains this tech lead through massive, consistent R&D investment. Fiscal 2025 R&D expense was $12.9 billion. Up 49% from the year before. And for the 12 months ending April 2025, it was over $14 billion.
Huge numbers.
This massive investment fuels that rapid innovation cadence. New GPU architectures roughly every year. Relentless pace. Hopper, Blackwell, now the announced Rubin platform. It continuously pushes the performance frontier, forces competitors to aim at a constantly moving target, reinforces NVIDIA as the industry leader. Looking at those numbers, something might jump out. R&D as a percentage of revenue actually declined from over 27% in FY23 down to under 10% in FY25. Doesn't that suggest maybe a reduction in innovation focus, or at least investment slowing down relative to their growth?
That's a crucial point, and yeah, superficial look could be misleading. While the percentage dropped, the absolute dollar amount invested in R&D is at an all-time high and growing rapidly year over year.
Okay, so the total spend is way up.
Way up. The real insight isn't a lack of commitment. It's a powerful demonstration of NVIDIA's extreme operating leverage and just the sheer scale of their revenue growth. Their revenue is simply growing so much faster than even their massive R&D spending. It shows incredible financial efficiency. It's not cutting back. It's scaling innovation at an unprecedented rate while also becoming incredibly profitable.
So it's actually a sign of strength, not weakness.
Yeah.
But does that extreme operating leverage also carry a risk? Could they become complacent? Or are the competitive pressures just too intense for that, even with such a strong moat?
That's a thoughtful question. I mean, while they have incredible leverage, the pace of AI innovation is just so relentless. The stakes are so high. Complacency would be, well, fatal. The competitive pressures are immense, as we'll keep discussing. Their continued massive R&D spend signals they absolutely understand this. It's a permanent arms race out there.
Okay.
Now, let's talk about how NVIDIA actually allocates all that capital, its strategic priorities. Given that immense free cash flow, they have huge flexibility. Their capital allocation strategy seems pretty clear. Reinvest heavily to sustain tech leadership while also returning substantial capital to shareholders. As we just discussed, the number one priority is reinvestment in R&D, driving future growth, maintaining that competitive moat. That nearly $13 billion R&D budget in FY25, up 49% year over year, underscores that tech supremacy is job one for management.
Okay, priority one, R&D. What about shareholder returns? They seem to use a two-pronged approach, but with a really heavy emphasis on share buybacks over dividends, right?
Yeah.
They have these active, substantial share repurchase programs. A $50 billion authorization announced mid-2025 after a $25 billion one in August 23.
Huge buyback programs.
Given the stock's high valuation, what's the main reason for these massive buybacks? Is it management thinking the shares are undervalued? Or something else?
That's a great question because, yeah, at these high valuations, it's usually not a direct signal of undervaluation. Instead, the primary motivation is likely as a tax-efficient way to return some of that massive free cash flow to shareholders. It also serves a really important function, offsetting the dilution from all the stock-based compensation they give employees, which is super common in high-growth tech, keeps the share count in check.
Right, offsetting stock options.
Exactly. Their dividend policy, though, by contrast, it's pretty nominal, clearly secondary. The company pays a quarterly dividend that, after their recent 10-for-1 stock split, is just 0.011 cents per share, 4 cents a year. Tiny. Results in an exceptionally low dividend yield, like 0.02%, and a payout ratio of just 1.3% of earnings. This policy clearly signals we're retaining the vast majority of earnings for growth, reinvestment, and buybacks, not for providing direct income to investors.
NVIDIA's also used strategic M&A acquisitions to boost its tech capabilities. That 2020 Mellanox deal for $6.9 billion seems like a clear strategic win, gave them that critical networking tech for the AI factory strategy.
Absolutely. Great acquisition.
But then there was that really ambitious but ultimately blocked attempt to buy ARM Ltd. Even though it failed, what did that attempt tell us about management's long-term vision?
That failed ARM deal, despite the outcome, it offered huge insight into management's incredibly ambitious long-term vision. It signaled NVIDIA wanted a major presence across the entire computing spectrum, from high-performance data centers and GPUs, all the way to low-power edge devices, and crucially, CPUs.
Covering everything.
Exactly. It highlighted their strategic thinking about the future convergence of CPU and GPU architectures under one unified platform, essentially trying to own the whole computing stack, top to bottom. Even without ARM, it showed they're willing to make incredibly bold, ecosystem-defining moves.
Okay, now let's pivot to the headwinds and challenges NVIDIA faces. Growth has been historic, sure, but the company faces some pretty significant operational challenges that can definitely impact its future. The most immediate and financially material headwind seems to be navigating those U.S. export controls on advanced tech to China. We saw the direct financial hit in Q1 FY26. That $4.5 billion charge for H20 inventory they couldn't sell couldn't ship another $2.5 billion.
Real money.
And looking ahead, management guided for an $8 billion revenue loss from H20 sales to China in Q2 FY26. How do they even navigate such a fluid, politically charged situation? And what are the long-term implications, especially for a market that was a decent chunk of their revenue?
It's an incredibly complex tightrope walk. And the situation is just constantly shifting. We had those reports of that potential 15% revenue share deal with the U.S. government. Highly unusual.
Very strange.
But then, complicated by reports of Chinese officials pushing back, apparently angered by those deeply insulting comments from the Commerce Secretary, pressuring domestic firms to buy less U.S. tech, which of course just speeds up China's drive for self-sufficiency. And if they succeed, that could seriously diminish NVIDIA's long-term market access in China, a market that was 13% of revenue.
So they're caught in the middle.
Totally. They have to constantly design new compliant chips, basically nerfed versions, giving up performance to meet regulations while also trying to manage customer relationships amidst all this geopolitical tension. It's tough.
And connecting this to the bigger picture, another challenge is the whole sustainability question. The explosive growth of AI has really put its significant environmental footprint under the microscope. Creates potential long-term risks for the whole data center ecosystem.
Energy and water usage.
Right. AI data centers are just voracious consumers of resources. Training, running these large models, incredibly energy intensive. The International Energy Agency projected this big surge in data center power consumption by 2026, driven mainly by AI's electricity needs. These models are energy hogs, plus they need massive amounts of fresh water for cooling. Example, Google's data centers alone used an estimated 5 billion gallons of water in 2022. That sounds like an environmental time bomb almost.
It certainly presents a growing challenge, This increasing environmental impact is attracting more scrutiny. Legislators, regulators, the public, in the U.S., Europe, there's a rising risk of future regulations, like carbon taxes, stricter water permits, things that could significantly increase the operating costs of data centers.
Right, make it more expensive to run AI.
Exactly. Plus, community opposition to building new resource-hungry data centers could physically constrain the expansion of the AI infrastructure that NVIDIA's growth relies on. These are real, tangible risks. Higher costs, maybe limits on growth.
Managing cyclicality is also key. In response to soaring demand and getting ready for big launches like Blackwell, NVIDIA's inventory levels have jumped significantly. From $5.2 billion in FY24 to $10.1 billion end of FY25, then up again to $11.3 billion in Q1 FY26.
Build up.
Now, while that's a logical response to demand, it definitely increases balance sheet risk if AI spending suddenly slows down. Though their inventory management metrics do show improvement after the post-pandemic mess. Inventory turnover recovered from a low of 2.99 in 2023 to 4.25 by 2025.
Better, yeah.
Does that increasing inventory level, even with better turnover, concern you at all? Given the industry cycles, could they get caught flat-footed if AI demand plateaus?
It's definitely a calculated risk, and one they probably have to take to meet this explosive demand, ensure they have product for huge launches like Blackwell, can't afford to miss sales. The improving turnover suggests they're managing it better than in past downturns. And remember, while gaming is smaller now, 8.7% of revenue, it is showing signs of recovery from that post-COVID crypto boom collapse.
Right, the crypto hangover.
Yeah. Q4 FY23, gaming revenue was down 46% year over year, but it grew 16% sequentially. Suggests maybe the market bottomed out? That stabilization is important for diversification, even if it's smaller now. Though it's worth remembering, they faced those shareholder lawsuits before, alleging they misled investors about crypto mining revenue being counted as gaming revenue.
Right, the volatility issue.
So they have a history of navigating these kinds of market shifts, for better or worse.
And beyond the data center, NVIDIA is making progress in emerging markets. Automotive looks like a significant long-term growth opportunity. They're pushing their D-Drive platform end-to-end hardware-software, aiming to be the central brain for autonomous vehicles, AI in the cabin.
Big potential market.
Revenue from automotive hit $1.7 billion in FY25. That's a 55% jump year over year. They've got design wins with major automakers, Toyota, Hyundai. Now, it's only about 1.3% of total revenue right now, but the potential market is huge. How significant do you think this diversification really is? Is it a future growth engine or more just a strategic hedge?
Oh, I think it's absolutely a future growth engine and a critical diversification pillar. Yeah, 1.3% seems small today. But the auto industry's shift to software-defined vehicles, autonomous driving, that's a multi-decade trend. Similar in scale, potentially, to the AI data center transformation. NVIDIA isn't just selling chips here. They're selling the whole platform, hardware, software, tools that becomes integral to the automaker's future strategy.
Locks them in again, potentially.
Exactly. Those design wins with major automakers are crucial. They imply long-term revenue streams for years. It's an investment in the future, definitely.
Yeah.
Hedges against over-reliance on the data center, taps into another massive AI-driven market.
Okay, let's step back now for a more comprehensive risk assessment. Beyond the headwinds we just discussed, one big risk is customer concentration and that hyperscaler in-housing trend. NVIDIA's biggest customers, Microsoft, Google, Amazon, Meta, are also its most significant long-term competitive threats.
The frenemies again.
Yeah. Their huge investments in custom AI silicon are explicitly aimed at cutting dependency on NVIDIA, lowering their own costs. How much of a threat is this really to NVIDIA's top line? Could faster-than-expected deployment of these in-house chips seriously dent demand for NVIDIA's highest-end, highest-margin stuff?
Yeah.
Or is that hybrid cloud scenario the most likely path?
It's definitely a significant and evolving threat, but that hybrid cloud scenario still feels most probable. Because of the breadth, the versatility of NVIDIA's platform versus the specialized nature of ASICs. However, the risk is that faster deployment of those in-house chips could indeed reduce demand for NVIDIA's very highest-end, highest-margin products, specifically for the hyperscalers' internal stable workloads.
The stuff they run for themselves.
Yeah, right. They might still offer NVIDIA GPUs for their external cloud customers, but their own internal consumption, which is massive, could shift away. NVIDIA's defense here: keep innovating relentlessly. Ensure their next-gen GPUs like Blackwell and Rubin offer such compelling performance and ecosystem advantages that even custom ASICs struggle to match them across all use cases. It's a constant race to stay indispensable.
Then there's the geopolitical and supply chain risk. As a fabless company, NVIDIA's business model is fundamentally dependent on third-party foundries, especially TSMC for the cutting-edge stuff.
Extreme dependency.
Creates extreme concentration risk. Any disruption to TSMC's operations, natural disaster, operational problems, or the big one, a geopolitical conflict involving Taiwan, that would have a catastrophic impact on NVIDIA's ability to supply its products. Plus, the ongoing U.S.-China tech rivalry creates this volatile, unpredictable regulatory environment. Persistent risk to market access, revenue stability. What would a catastrophic impact truly look like for NVIDIA and maybe the whole AI industry if TSMC faced a major long disruption?
A major prolonged disruption at TSMC. It would be an existential crisis for NVIDIA and frankly, for a huge chunk of the global tech industry. Almost all advanced AI development would grind to a halt. It wouldn't just mean delays. It would mean a stop in production for their most advanced chips for months, maybe years, severely hitting revenue, market share, stock price, everything.
Total chaos.
Total chaos. The ripple effects across the whole AI ecosystem, so dependent on NVIDIA GPUs, immense, slowing down research, development, deployment globally. And right now, there's no single alternative foundry with the same advanced capabilities as TSMC at scale. Makes this a truly unique, elevated risk.
We also have to consider the sustainability of the current AI spending boom. The level of global investment in AI infrastructure right now is just unprecedented.
What the charts?
A primary risk is that this is just an initial, massive build-out phase, and it will inevitably slow down or maybe even enter a cyclical downturn as the market matures. The CapEx plans of just a handful of hyperscalers. That's the single biggest driver of NVIDIA's revenue. Any significant cutback or pause in their spending would have a direct, severe negative impact on NVIDIA's growth. Is there any historical precedent for a build-out this big that gives clues about when a slowdown might hit? Or is this totally uncharted territory?
That's a tough one. The scale and speed are somewhat unprecedented. But history does offer lessons from other tech infrastructure build-outs, right? The dot-com boom, the initial cloud build-out. There are always cycles. Massive investment followed by digestion phases where spending slows. The question isn't if it will slow, but when and how sharply. Hyperscalers are basically building a new utility. Eventually, that build-out hits some level of saturation for current demand. The risk for NVIDIA is that the market is currently pricing in sustained hypergrowth. Any significant deceleration would be met with a really harsh market reaction.
And of course, there's always the risk of technological disruption in this industry. NVIDIA has a huge lead now, sure, but the history of semiconductors is just full of rapid, disruptive innovation.
It's constantly changing.
The risk remains that a competitor AMD, maybe a new entrant, could achieve some architectural breakthrough, challenge GPU performance, or maybe more critically, finally undermine CUDA's dominance. What would be the most likely form of disruption? A totally new chip architecture? Or maybe a breakthrough in open-source software that finally cracks the CUDA lock-in?
That's the billion-dollar question, isn't it? A totally new chip architecture seems less likely as a sudden disruption just because of the immense R&D needed. But a significant breakthrough in open-source software, one that truly replicates CUDA's performance and ecosystem, that could be highly disruptive.
A true CUDA alternative.
Imagine a genuinely open-source platform. Developers could easily port their CUDA code to it, get comparable performance across different hardware. That would massively reduce switching costs, fragment NVIDIA's software moat. It would take a huge coordinated effort, but it's a theoretical vulnerability for sure.
Which brings us to maybe the most important question for investors right now. What does NVIDIA's current valuation actually imply? The company's market cap clearly reflects expectations of near-flawless execution, sustained high growth for years. The stock is, essentially, priced for perfection. Consequently, any sign of slowing growth, margin compression, product delays, failure to meet targets, could trigger a significant rapid derating of its valuation multiples. To put that in context, let's look at the valuation. NVIDIA trades at a huge premium to the broad market, most peers, reflects its superior growth, profitability. As of August 2025, the trailing 12-month PE ratio was around 57. TTM price to sales around 30, price to book over 50. These are big numbers.
They are high, yeah, but not entirely without precedent for NVIDIA during rapid growth phases. Their 10-year average PE is actually 52.87, though it's been volatile, peaked at 138 back in April 2023. The current PS of around 30 is notably above its 5-year average of about 23, so the market is willing to pay more per dollar of revenue than it has historically.
And yeah, if you compare NVIDIA's multiples to peers like AMD, Intel, Qualcomm, Texas Instruments, they're substantially higher across the board.
What does this premium really tell us? Why does the market accept such a big difference for NVIDIA?
Well, the premium seems to be a direct function of those superior operational metrics we talked about. Gross margins around 70% versus 40-58% for peers. Much higher growth rates. The market clearly believes this combination of high growth and high profitability is not only sustainable, but also uniquely positioned for the AI future. If you look at it from a growth-adjusted perspective, the PEG ratio, price earnings to growth, helps contextualize the PE.
Right, PE relative to growth expectations.
NVIDIA's forward PEG, based on analyst estimates, is in the range of 1.56 to 1.98. Now, that's not like extreme territory, but it does suggest the market is paying a premium relative to its expected future growth rate, meaning a significant amount of strong future growth is already factored into the current price.
And when it comes to trying to figure out an intrinsic value, attempting a precise number for NVIDIA using a discounted cash flow model, a DCF. The analysis says that's an exercise fraught with significant challenges. Why is DCF so hard for NVIDIA specifically? It's a standard valuation method.
It's hard because DCF requires forecasting free cash flows way out into the future. And for a company like NVIDIA in this unprecedented hypergrowth phase in such a dynamic cyclical industry, long-term forecasts become highly uncertain, basically guesswork after a few years. The output of a DCF model is acutely sensitive to the core assumptions you make, especially the discount rate, the WACC, and the perpetual growth rate you assume for the terminal value.
Tiny changes have huge impacts.
Exactly. A minor tweak of just 50 to 100 basis points, 0.5% to 1% to either of those, can change the calculated intrinsic value by hundreds of billions of dollars. Given how hard it is to predict when NVIDIA's current 50% plus growth will slow down to a sustainable long-term rate of, say, 3–4%, any single DCF number has to be viewed with extreme caution.
So, okay, if a precise DCF value is tricky, what's the takeaway?
Rather than aiming for a single magic number, it's probably more useful to understand what the current market cap implies. At its current massive valuation, the market is implicitly forecasting that NVIDIA will not only meet but likely exceed consensus growth expectations for several more years, that it will maintain its industry-leading profitability, successfully defend its market share against that rising competition, and navigate all those complex geopolitical risks without significant disruption.
So basically flawless execution.
Pretty much. The investment decision, then, really hinges on your confidence, your belief in the company's ability to actually deliver on these exceptionally high expectations that are already priced in.
Wow, okay. What a deep dive indeed. We have covered a lot of ground today. Let's try and recap some key insights. NVIDIA, clearly the architect of AI, right? Built this incredible moat with its full-stack platform, especially CUDA.
Software lock-in, yeah.
Financial performance, extraordinary, unprecedented. But it faces this formidable array of challenges. Intense competition, including from its own biggest customers, significant geopolitical risks, supply chain dependencies.
Lots of hurdles.
And as we just discussed, these immense expectations for its future performance, they're already baked into that high valuation. It's just a really compelling, complex story. It touches on so many facets of tech, global economics.
It really is. It's a testament to incredible innovation, strategic foresight, but also a case study in the huge challenges that come with being king of the hill in such a fast-moving industry.
So what does all this mean for you, listening in? Consider this. NVIDIA's trajectory isn't just about one company. It's really a mirror, reflecting the future of computing itself, reflecting the intensity of global tech competition, reflecting the staggering resources needed to power this AI revolution. The question isn't just, can NVIDIA keep growing? It's also, what does its success or its struggles tell us about the limits, the possibilities of this whole AI-driven future we're heading into? What stands out to you as the most defining factor in NVIDIA's story moving forward? That's something to ponder on. Thank you so much for joining us on this deep dive into NVIDIA's AI empire. We hope you feel a little more informed and maybe, hopefully, a lot more curious. Until next time, keep digging, keep learning, and keep diving deep.